Welcome to Standard & Poor's July Loan Market Overview. I'm Steve Miller, a member of Standard & Poor's Leverage Commentary and Data Team, a unit not affiliated with S&P Ratings. For the next 5 minutes or so, I'll walk you through a review of the recent loan market trends before winding up with some themes to watch for in July. For real-time updates on the loan market, please follow LCD on Twitter, Facebook, and LinkedIn. You've all seen this before. It's a disclaimer that's long and quite detailed. Please read it at your leisure. The S&P LSTA index continued to trend lower in June, but the loss moderated to 23 basis points from 2.2% in May. During the first half, however, loans were up 3.3%. In the new issue market, arrangers were busy resetting spreads for today's more challenging landscape. By and large, clearing yields are up about 150 basis points over the past 8 weeks, though your mileage may vary based on deal size, complexity, and rating. The loan market continued to suffer from soft technicals in June, though conditions improved a bit from May. As well, investors remain cautious in response to disappointing economic reports as well as weakness in the stock market. Despite poor technical conditions, the market continued to enjoy sliding default rates in June. Pressured by the ongoing sovereign debt woes in Europe and soft technical conditions, loans traded lower in June. LCD's flow name composite, shown here, is a sample of the 15 largest names in the market. The composite traded off 0.6% in June to around 91 after falling 4% in May. Year to date, the average is off about half a point. With the secondary trading off and technicals cooler, arrangers spent the past month repricing higher new issues. On average, new deals printed in June at 7.8%, up from 6.4% in May, and the highest level since last September. Looking ahead, arrangers bracket BB new issue yields at 6 to 7%, B plus B1 yields at 7 to 8.5%, and B2 yields at 8 to 10%. These ranges are wide to account for different levels of size and complexity. How well followed the issuer is also plays a role in where it can print naturally. This chart shows the return by month of the S&P LSTA loan index. As mentioned, the index dropped 23 basis points in June after declining 2.2% in May. Still, it remained up 3.3% for the first half. That compares to a gain of 4.7% for high yield and a loss of 6.7% for the S&P 500. In June, with investors scrambling for high credit ground, better rated loans outperformed, with BB loans losing 23 basis points, single B loans off 64 basis points, and CCC loans off 109 basis points. Year to date, however, CCCs continue to outperform at plus 12%. As this chart demonstrates, volume ebbed in June to $10.5 billion despite a flurry of late month launches. But with the high yield market producing fewer takeout deals, outstandings were little moved. Looking ahead, participants expect the summer months to be choppy and slow, with arrangers releasing deals from the calendars when pockets of liquidity develop. Market fundamentals continued to improve in June. During the month, there was not one new loan default, the first time that's happened in 2.5 years. As a result, the lagging 12-month default rate continued to ease, dropping to a year-and-a-half low of 4.1% from 4.6% in May and 9.7% at year-end. As we discussed last month, improving EBITDA was largely behind the decrease. Other factors include the fact that so many highly leveraged issuers in troubled sectors like auto, gaming, and real estate have already defaulted, leaving a sturdier population of performing issuers. As well, with liquidity stronger, companies are better able to buy time by executing amend to extends or bond takeouts or by selling off assets. Looking forward, the consensus among loan managers is for default rates to drop to about 4% by year-end, assuming, of course, the economy avoids a double dip. Though after the roller coaster ride of the past several months in the stock market, economic growth seems far more fragile than it did in the first quarter. To wrap up then, some final points. With a market skittish, most participants think that technicals will continue to favor buyers, though at current levels, the market has moved into some sort of equilibrium. In all likelihood, therefore, arrangers will play a ball control offense over the summer, rolling out loans when liquidity waxes and holding them back when it wanes. Deal capacity is constrained by slower repayments and bond takeouts. Where arrangers had speculated on $4 billion loans and $10 billion LBOs a couple of months back when the markets were running hot, those capacity estimates are now about half the size. With this in mind, private equity firms and issuers will likely focus over the summer on tactical executions like amend to extend and sponsor to sponsor flips. More opportunistic business like public to private, LBOs, and repricings are largely off the table until conditions improve. Defaults, by all accounts, will continue to slide further even if the economy continues to bounce along. Most buy-side managers see a year-end rate of about 4%, and the first half run rate is actually just half that. That brings us to the end of our review. I hope you found it informative. For more information on the loan market, you can check in with us on the web or via LinkedIn, Twitter, or Facebook. The links for each is on the description for this video below. Please visit us. We plan to update this video analysis monthly, and we'll have other videos as well.